Hello and welcome to Grant Accounting for Unrestricted and Unconditional Grants. In the previous video, we talked about how every grant falls into one of four buckets, and the bucket it falls into will make a difference as to how you account for it. And these were unconditional restricted, the unconditional unrestricted, conditional restricted, and conditional unrestricted. In this video, we're focused on unconditional and unrestricted grants. Once you've determined a grant follows that, here's how we account for it. GAAP requires that if it's unconditional, that we recognize it as revenue immediately. So let's look at an example. Here we've got a situation where we've got a budget for admin at $10 a month, fundraising at $10 a month, programs at $80 a month, and expenditures totaling $100 a month. And when we look at the little dots there, that's June, July, August, September, October, November, and December. So the total for the year on the extreme right is 120 for admin, 120 for fundraising, 960 for programs, the total expenditures of $1,200. So we know we need to raise $1,200 and we start a fundraising campaign for the $1,200. And lo and behold, we get the $1,200 in January. We get an award, a grant of $1,200 in January. When you book that revenue as GAAP requires, what you'll see is that the net income goes to $1,100 for January. And then for each month thereafter, you're looking at a loss of $100 a month, which ends the year with a nice net zero, meaning that you fully funded your operations for the year. Now, what happens if the money was received in December? You started your fundraising in December. It's possible that somebody gives you funding in December. When you get that money in December, you have to recognize revenue, which means that your net income for December will show 1,200, particularly if you haven't had any other expenses. It's a startup. And then January through December, you'll show losses of $100 a month. So while this is correct from a GAAP perspective, because that 1,200 in December closes out to net assets, and then the 1,200 for the following year, also the negative 1,200, also closes out to net assets and it washes. When management looks at these reports and sees the $100 loss every month, they might get concerned. So management reporting is different from GAAP reporting, and how you handle that depends on whether you want to maintain separate records or you want to try and integrate it and handle it within the core accounting system. So we've made that $1,200 profit here, and we've got a $1,200 loss here, which washes. It's just that management issue that we need to understand. So how do we account for unconditional grants? We have to recognize it immediately. And this is the matching issue that nonprofits often struggle with. So the rules say that it needs to be recorded immediately when a grant is awarded. And awarded is when the grant letter is received, whether or not the funds are received. And this causes some of the challenges with the matching concepts that we're familiar with in other businesses. Nonprofits have to work with this constraint. So what are the accounting entries for these unrestricted and unconditional grants? So we've got this $1,200 in January. And what entries are booked in January? Well, since the check is received and we deposit it, the entry will be debit bank $1,200 and credit revenue $1,200. And these entries are in January, resulting in a net of $1,200 for January and losses of $100 a month for the remainder of the year, ending the year at a net zero. But what if the check is not included? Well, in that case, we set up an accounts receivable for $1,200 and we credit revenue $1,200. And then when the funds are received, whether they're received in total or in pieces as they come in, we go ahead and debit bank and credit the accounts receivable. What about the example where the money is received in December, the grant is awarded in December? First entry would be in December. This is not in January. It's in December, the month you receive the funds. You debit the bank for $1,200 and you credit revenue for $1,200. But what if the check's not included? All you have is the grant letter. Well, then, once again, we do the accounts receivable for $1,200 debit, and we credit revenue for $1,200. Then, as the funds come in, or as you bill and collect, you'll go ahead and debit bank and credit AR. Let's assume we get the check in one go. We debit bank $1,200 and credit the accounts receivable. You can already see looking at this that this might create a management reporting issue. So you can track this within your core accounting system, or you can track this management reporting in a separate system. We suggest that you keep it in your core accounting system, and it might take some special adjustments or treatments with your chart of accounts and some processing entries that you need to handle. We'll cover that in a separate video. So looking at that flow, every grant needs to be classified into one of these four buckets. In this video, we covered unconditional, unrestricted grants. In the next video, we'll cover unconditional and restricted grants. And after that, we'll address conditionals, both unrestricted and restricted. So let's share some closing thoughts here. We can see that there's an issue between GAAP reporting and management reporting. Now, not every nonprofit is required to follow GAAP reporting. So the first order of business is to determine whether or not your nonprofit needs to follow GAAP reporting. If it does need to follow GAAP reporting, then you've got to think about how you're going to handle management reporting. Are you going to do a separate accounting system on the side for management reporting? Or are you going to set up a chart of accounts and processes such that you can do all of this on one platform? So these are some of the things we'll cover in upcoming videos. I hope you found this helpful. Please comment and let us know what else we should cover. Thank you so much for watching.